So what we're going to start with is just looking at the big beautiful bill. Okay. The big beautiful bill passed this year and how it affects rental property owners. Now, what I don't want to do is I don't want to assume that everybody that's on this call is a rental property owner. Maybe they're people that are going, hey, because of the big beautiful bill, hey, they're bringing back this tax incentive. So now I might start buying rental properties. So what I've learned is we actually are the largest cost segregation firm in the United States, and we're based out of Louisiana, which is very always humorous. But we've learned is the lion's share of my clientele that is in the far west, or Pacific West, or in the Northeast, they don't even know about cost segregation studies. I'm not sure why. So I just would rather just not assume. Okay. So we all do know that those that are rental property owners, there are large tax codes strongly favoring rental property owners. So there's one thing that I want to make sure. I started buying rental properties back in 2011. And it took me about 5 years to even understand what a depreciation schedule is. What is that? All a depreciation schedule is when you buy a property, you have your purchase price minus the land value, and then you're able to depreciate that property over 27.5 years or 39 years. So let's just say for easy numbers, let's say we're talking about $1 million a building basis. We divide that by 39 years of its commercial, and let's just say it's $25,000 a year. So every single year, you are able to you don't pay taxes on the first $25,000 of rental income. It's pretty amazing. So that's something that's very, very unique. Can you imagine on your regular job if the first $25,000 of income just wasn't taxable? Well, that's the way it works for rental property owners. So this is just something that is huge. The next is bonus depreciation. Because of a cost segregation study, you were able to, rather than taking that $1 million over 27.5 years, remember, we're depreciating our building costs over 27.5 years or 39 years. The IRS code says, hey, if you're willing to pay some engineers, they'll place value on your building components, and any of the building components that qualify to be taken up front, you don't have to wait 27.5 years or 30 years. Okay. So these are some very, very unique tax strategies that a lot of people, to be bluntly honest, are just missing. And I really, truly think, and I'm saying this with all integrity and all honesty and all CPAs are doing their darndest, but they're barely above water because they're so overwhelmed with this tax law. So they don't always have time to be telling you, hey, you need to be spending, because a cost segregation study is not free. It costs money, anywhere from, let's say, 3,000 to 5 to 15,000. So in reality, they're just thinking, I'm not interested in telling someone how to spend their money. We'll set it and forget it. We'll know that John will need that depreciation over the next 27.5 years or 39 years. We don't need him to spend money for that. Who knows? Maybe if he takes this depreciation, he takes 30% of the depreciation now we're going to have 70% less. Well, our reality is you're a business owner. If the IRS is holding on to your asset for 27.5 years or 39 years, and the IRS says, hey, you can take 30% of that up front right now. I'm just saying, as a business owner, I'd like to know that. And what's the cost to do that? So this is what is so unique about the big beautiful bill when it comes to real estate. Okay. Now, I know I kind of jumped into what cost segregation, but let me explain to you once again what it is. All cost segregation is, back in the late 1990s, there was a lawsuit. And the lawsuit was a hospital against the IRS. And the hospital basically said, the hospital attorney said the following: we just spent $100 million on this building. And a commercial building is depreciated over 39 years. Why are we having to take $100 million of depreciation over 39 years when we all know that building components have a tax life. Some of it is 5 years, some of it is 7 years, some of it is 15, some of it's 20, some of it's 39. And that's when the IRS said, okay, hang on, stop. We get it. We're not construction engineers. We're not appraisers. So we're just going to assume that you're going to take that 100 million over 39 years. That's when cost segregation studies were born. There was no such thing before that. So this was back in the late 1990s. This even came about. And that's when it came to the realization the IRS said, you're going to need to hire an engineer. You're going to need to hire an engineer that knows how to place value on a building component. And then also, what tax life does it fall? It's fall into 7 year, 5 years, 15, 20, or 39. So in reality, all a cost segregation study is you're willing to say this. If the IRS, and I'll say on average, let's say on $1 million building, on average, you're going to be able to accelerate anywhere between 20 to 35%. So let's just take 25%. 25% is $1 million. Excuse me, 25% of a million is $250,000. So with a cost segregation study, all you're saying is this. If I can get $250,000 of my depreciation now for it to offset my income now, why would I wait 35 years, 39 years to do that? And the answer is you don't have to. But there's a cost, like anything else. So that's where the CPA normally has the disconnect. It's in their brain, his or her brain, they're of the mindset that, hey, John, you're going to get it anyway. Why would you spend $3,000 to $15,000? Why would you spend it? Well, because if Chris is saying I can take 250,000 of this now, why would I wait 39 years? Like if I'm at a 30% tax bracket or 40% tax bracket and I'm offsetting 250,000 of my income, that's enough of a down payment for me to go buy another property. Why would I let the IRS hold my money for 39 years? That's the reality. That is all we're talking about is would you pay a one-time fee to get all of the tax benefit that the IRS will allow you to do? That is it in a nutshell. Okay. So yes, are there realities of when you sell the property? Yeah, those are things you take into consideration. You look at 1031 exchanges. Some of the times you're a buy and hold person. But once again, the overall reality is I even have clients that do cost segs, even though they know they're going to flip the property in another year. And I have reasons. They have reasons why. So the reality is your situation is completely unique. And you have to determine, just like what what these guys are doing for you, is you don't want to have just some blanket plan. You want to make sure is don't just assume cost segregation doesn't make sense for you. I've had CPAs go, well, yeah, it's only a $400,000 property. And I said, we go down to 200,000. They're like, what? I thought this would be like $8,000. Well, I mean, on a $1 million property, you're talking about $4,500. Would you want to offset $250,000 of your income? This is what I always tell my clients. This is not a tax decision. This is a business decision. Do you want to spend X amount of dollars to receive that tax benefit now rather than the IRS holding it on to it for 39 or 27.5 years? This is the one thing that I want to make sure that everybody's on the same page. Matter of fact, I'm going back to this because I actually missed the most important part. What is this big, beautiful bill? What the big, beautiful bill did, and this, if you're taking notes, this is probably what's the most important part because that's the topic, is big, beautiful bill. So I almost missed this whole point. That'd have been really fun. And Kendall would have been like, Chris, you missed the whole point. So here we are. What is this 100% bonus? What's this big, beautiful bill? What I want you to write down is if you own any properties that you bought before November of 2017, okay, you don't get bonus. Any property that you bought after November 2017, all the way to the end of December 2022, you get 100% bonus. Now remember, when I say 100% bonus, what does that even mean? What that means is that if you take 100,000, excuse me, if you have $1 million and we can accelerate 30%, that's $300,000. So that would mean that you could take the full 100% of the $300,000. So I want to make sure that everybody understands that. Now, once again, this is really about everybody's different, but it's all about the in-service date. It's all about when did you place it in service. So what happened in 2023, the big beautiful, the bonus started to uh, phase out. So if you bought or placed, remember, the word is placed in service. When did you start renting it out? If you have a property that you started renting out in 2023, the bonus was 80%. So remember, we're using this example again. $1 million, we can bonus 30%, 300,000. If you placed a property in service in 2023, you get to bonus 80% of 300,000. Then we got 2024. So 2024 came along and it dropped to 60%. So then you can take 60% of the 300,000. Then the big beautiful bill came along for 2025. So the way this works, to not get really complicated, is any property that was placed in service. Now here's where it's a little bit confusing about the big beautiful bill. So if there's something that's really confusing, this is it. Before the big beautiful bill, the only date that mattered was the in-service date. The in-service date is when you start renting it out. The big beautiful bill says that to get 100% bonus, you have to have purchased and placed the property in service after January the 19th of 2025. So we know that anything after any purchase, let's keep it simple, any purchase after January the 19th of 2025 gets 100% bonus for the next 3-4 years to be safe. But I also want you to recognize that you can always go back and study properties that you've owned for 10 years without having to amend a return. That is huge. Because who wants to go amend a return? I know I don't want to. So you can study a property that you placed in service in 2019, 2018, 2017, even before that. You can always go and study it without amending your return. So the big beautiful bill is saying everything pre January the 19th of 2025 stays the same. So you don't get to carry forward. So any property you bought before January 19th of 2025 stays the same. It doesn't get grandfathered to be 100%. But any property you purchase after January the 19th of 2025 gets 100%. So now we have 100% for the next 4 years after January the 19th of 2025. That's the key, making sure y'all know this. Why am I talking about a short-term rental? Remember we talked about when you're doing a cost segregation study, it's about how it flows through to the person or the LLC. For this to go against your total income, remember this. Remember the cost segregation study, the million? We can accelerate 30%. We're going to make an assumption that we're at 100% bonus. So we can accelerate our bonus 300,000. If you're a real estate professional, meaning you're in this full time, you're able to use that against your total income. And if you're married, filing jointly, it's against the total income of you and your spouse. Okay? But if you're not a real estate professional, what constitutes a real estate professional? It's an individual that at least spends 750 hours of their time, and it's normally their primary occupation. It's normally going to be developers, builders, commercial brokers, people that are in full-time real estate. If you're in full-time real estate, there's a very strong chance that you will qualify as a real estate professional for that $300,000 to go against your total income. But if you are not a real estate professional and you got a W-2 job on the side, then if you own rental properties, the 300 grand that you receive from the cost seg only goes against the total amount of passive income you have. That's a huge difference. So where did this short-term rental thing come into play? This is why short-term rentals have gone berserk. And I hate that they're calling this a loophole. They call it the short-term rental loophole. A loophole means it's a red flag. 70% of my business comes from short-term rentals. And all that it is when you buy a short-term rental, it's considered a business, not a rental property. Now, why is a short-term rental a business? Because the average stay is normally 7 days or less. That means you're actively being involved and you're running a business where normal rental properties are what? Passive. You have a renter, you don't have to worry about them. They send you money. They got a problem. They call you. You might have to go do something 2 times a year. In a short-term rental, ooh, you're sending maids out. You're having, I mean, literally, you could get a call from every one of your new tenants from a short-term rental. So the IRS allows there to be some flexibility. And in that flexibility for a short-term rental, applies to three things. A short-term rental, if you own a motel or a hotel, those are considered businesses. So if you are materially participating at least 100 hours a year, that's the number one. Number two, that you're not using your short-term rental for a vacation rental where you're spending more than 13, 14 days a year. It needs to be a short-term rental, a business, not something you're using 3 months out of the year. Okay? And then the last qualification for you to get the tax benefit of a short-term rental, remember, once again, for you to take that $1 million property, accelerate and get 30% of the benefit. Remember, the reason why we're saying about short-term rental is it goes against your total income. Where for any other type of rental property that you're not a real estate pro, it only goes against your passive. So this is my point for saying this. If you know that you're a real estate pro, the world is your oyster. Go buy whatever the heck you want. Cost segregation is going to rock your world. It's going to be great. You can't mess up. But if you're not a real estate professional, when you do a cost seg, and you're buying anything other than a short-term rental, motel, or hotel, then the cost seg is 300,000. Remember the million, 30% is 300 grand. It only goes against your passive income. And maybe your passive income off of all your rental properties is $80,000 a year. Well, it might take you over 3 years to use the benefit. That's not a big deal, but it's still not as fast as getting it in the very first year. So a short-term rental, as long as you hit those three material participation, what is the third one? I forget about the third one. It says that no other individual has done more hours than you. So you got to make sure that when you're running a short-term rental, you got to make sure, is there anybody else there that's doing more hours than you? And it's normally going to be a maid service. So there's strategies on making sure that there's no way that a one individual maid's doing more hours than you. And if you can make sure that you can hit those criteria and with confidence, then now you get the same benefits as a real estate professional. You're able to use the cost segregation to offset your total income, if you're married, filing jointly, against you and your spouse's income. That's why I have so many attorneys, so many doctors, so many high income people that have these they got their own W-2, they got their own W-2 job. They're not real estate pros. And they're like, well, hang on, I'm just going to focus on short-term rentals. And I'm like, yeah, of course you would. Why would you do anything different? So this is why I'm really being strategic with this, because in reality, a lot of people don't understand this and they don't know this. If you are a builder or if you are a developer, it's all about planning, because you are the one that's actually building the property. So when you're building a property and you understand cost segregation, it's very, very important to know Remember, maybe I didn't share this with you, so please forgive me. In a cost segregation study, only the building components that have a 20-year tax life or less can be accelerated or bonused. So 5-year, 7-year, 15, and 20-year. So as long as a building component falls into one of those 4 tax lives, then the IRS allows us, according to the tax law that was passed in late 2017, that says as long as the building component falls in a 5, 7, 5, 7, 15, or 20-year tax life, you can take it all up front. Now, you cannot take what falls into 27.5 in 39 years. And what I want you to think about what part of the building or property is going to last 27.5 or 39 years. That's why they're saying you can't bonus it. We're just not, it's structural. It's going to be there. It's going to be there for a long time. We're not going to let you take it up front, but we will let you take things that are depreciating at a 20-year tax life. We'll let you take that up front. That's just in the code. That's just the way it works. So if you're a builder, and I've had maybe 3 of my clients do this, and I always go, guys, if you're and my brother's a very big developer, and I say, Brian, let's not forget when you're about to build a building, especially of this size, let's make sure we know how you could potentially structure building this building to make sure that the building component qualifies for a 5, 7, or even 20-year, or even 15-year, because 15 years is something called land improvements. And there's things that a builder could construct that if you don't do it according to the tax law, it'll just be thrown in the 39 year, the 27.5 years. So as a builder, it's very important to get to know, hey, are you telling me there's 30 different ways that I can put together this a business model of how we're going to build this building? If I do it this way rather than this way, I get to accelerate the depreciation versus I don't. Well, wouldn't I want to know that? It's just most people don't take the time. It's just they don't know. It's not what they do for a living. They build buildings. So note to self, and I'll give you just a couple little realities that I think in reference to being a builder. For example, and these are just a handful. Let's say the building assumes, hey, I'm just going to put in standard lighting. Well, if you use track lighting or accent lighting, it's 5 years. But if you do standard lighting, it's either 39 or 27.5. Now, why is that important? Remember, guys and gals, standard lighting is 27.5 or 39. And what that means is it can't be accelerated. You can't take it now. If you do it this way, you can take it now. When it comes to kitchen, equipment, circuits, if you do it generally, a general building electrical, it's 39 or 27. If you follow the bylaws, all your electrical in the kitchens are going to be 5-year. Same thing if we're obviously talking, we have a lot of, people that are using electric cars and a lot of things that are electric. And so most people are not taking that consideration. Well, anything that's EV charged is 5-year. So a builder might say, well, I didn't know that. I didn't know I could. So you're saying if I spent $500,000 on EV chargers and what I could take that now? Oh, I didn't know that. I just was going to do everything traditionally. This is another thing. Let's say standard flooring. Most builders don't mind using luxury vinyl as long as it looks nice. Well, that's 5 years. Or if you have nailed down wood flooring, that's 39 or 27.5. So these are and this is also a little bit unique. And I think you got to make sure this is done properly. But even in cabinetry, as long as you have cabinetry that's only held up by screws, if you can pull the screws out and it does not affect the wall, they consider it movable. And anything that's movable is 5 years. Now, I think that's crazy, but it's still within the tax law. So these are just things that we wouldn't thought would be possible. But if the cabinetry is attached to the wall, and if you pull the cabinet and it rips the sheetrock off, nope, that's 27.5 or 39. But if you can take the screws out and it just comes off and it's just kind of like a little bit of putty, that's 5 years. Now, once again, I don't make the rules, but this is the way it works. For example, when you're dealing with what I call 15-year property, that's all of the assets that are outside of the property, the parking lots, the sidewalks, the landscapings, the pole lighting. We just want to make sure that we understand that that's not considered structural. So there's a benefit in maybe spending a little bit more money there because that's the curb appeal. It's the landscaping. What does the signage look like? So these are just a couple things that a builder would want to understand. Now, this one, to be honest, is kind of the one that I think everybody misses. And I missed it for the first 2 years. And I do this for a living. I've done it for 7 years, 6.5 years. You think of cost segregation, if you know anything about cost segregation, you think about it, you're studying a building. And so when you think of a mobile home park, you're thinking like, what am I really studying? Like it's just a mobile home. But a mobile home park and an RV park, there's normally not a lot of structures. What you're normally paying for when you buy, I'm going to take them one at a time. Let's say a mobile home park. In a mobile home park, when you buy the mobile home, you can either do it two ways. You can buy a mobile home park and it be tenant owned, meaning the tenants own the mobile home park. The tenants own the mobile homes, but you own the park. So what's the park? Well, that's the pads. That's the concrete underneath every mobile home. That's the hookups. It's the tie-ins. It's everything that makes that mobile home like home. All the things that you have on your house. They have to have the electrical, the plumbing, the tie-ins. That's all considered 15-year land improvements. A mobile home, if it's truly a mobile home, has a 20-year tax life or less. Because we know mobile homes don't last forever. They don't last 27.5 years. They don't last 39 years. So if you literally bought a mobile home park, I'm just going to make this real simple. Let's assume there's not a bunch of structures. Just a mobile home park. It's got paved roads. It's got pads. It's got tie-ins. Traditional. Doesn't have a bunch of restaurants on it. Doesn't have an amusement, like a rec center. But if it's just a traditional mobile home park, if you spend $1 million on a mobile home park, and let's say the land value was 20%. Remember, you never can depreciate land. So it's your purchase price minus the land value gives you what's called a building basis. So $1 million minus 20%. So you have an $80,000 building basis. Now let's assume this was a regular commercial building. Remember how we used the word, remember we said it could be anywhere between 20 to 35%. So we're going to use 25 or 30. We'll use 25. If this was a traditional building, million minus 20% is an $800,000 building basis. If this was a normal building, multifamily, commercial, even residential, let's assume it says 25%. Well, then you would get 25% of the 800,000. 25% of the 800,000. If this was a traditional mobile home and it was just mobile homes, you would get up to 100% of the 800,000. That's a huge difference. So in a mobile home park, literally, if you do a cost segregation study, you're getting 3 to 4 times the tax benefit for the same cost of a study. So I don't know if you love mobile home parks, you don't like mobile home parks. But from a cost segregation standpoint, if you can wrap your brain around mobile home parks and it makes sense and the cap rates work, You're getting 3 to 4 times the tax benefit for the same cost than if you studied any other property. Note to self. It took me 2.5 years to figure that out. And I was like, what the heck would that be of any benefit? Now we have an RV park. I would say they're second place because an RV park has the same things. It's just pads, hookups, tie-ins, roads. But normally in an RV park, it's normally more recreational. It's not, people don't normally live in an RV park. They normally live in a mobile home park. They don't live in an RV park. They're kind of the weekend warriors staying there for vacations. So normally they have a little bit more, a couple more structures, maybe a large restroom, maybe a rec room. So on a property like an RV park, maybe you can accelerate 60 to 75%, where a traditional building might be 20 to 35. So I'm just throwing things out for people that are open-minded, that are willing to say, hey, if I can make the numbers work on a mobile home park and RV park, and I like to offset taxes, you're literally doing 2 to 4 times better from a tax benefit by doing RV parks and mobile home parks. So this is just something that I want to take a little bit of time and share. But I would say the biggest obstacle that anybody on this call will have is the pushback. And the only pushback you're ever going to get from a CPA is this is what I want you can hold me to this. This is what happens almost every time. If it does happen, if there's somebody that is not familiar with cost segregation, what they'll say is the following. You know, John's the customer, the CPA. I'm the CPA. Hey, John, you know that, on this $1 million property, you're paying $5 million. Excuse me, this $1 million property, you're able to depreciate this over, you're going to get the tax benefit. Do you understand that, John? And this John's like, CPA, what do you mean? I'm going to get it anyway. Well, John, on this $1 million, if you take 1 million and divide it over 39 years or 27.5 years, every single year, you're going to get what's called a depreciation expense to offset your income. Just like I said on the million divided by 39, every single year, you're going to get that depreciation expense. And then John's like, I'm not even sure what do you mean I'm going to get it anyway? And I'll step in, I'll say, John, what he's saying is this $4,000 to $5,000 fee? He's saying you don't have to pay it. And John's like, what if I don't pay it, how do I get that $250,000 to $300,000 tax benefit now? Well, you can't, John. That's what a cost segregation study does. So this is what happens. I'm not kidding you. In a live Zoom call, John will look at the CPA and go, wait, you're saying if I spend $5,000, I can offset $250,000 to $300,000 of my income. And what would make you CPA think that's not a good idea? I mean, if you want to spend the money, you can, but you're going to get it anyway. And John's going, whoa, hang on. If I'm at a 40% tax bracket and I'm offsetting 300 grand, that's $120,000 I just saved. Well, yeah, I mean, but John, you're going to get it anyway. You're just getting that $120,000 over a 39-year period. John's like, wait, I'm going to write a check for $5,000. I want to get the $120,000 now so I can go buy another property, a down payment. And I just want to do this over and over again. Well, John, if that's what you want to do, that's fine. But I'm not here to tell you how to spend your money. That's just what happens. I'm not here to tell you how to spend your money. That's why I always say cost segregation is not a tax decision. It's a business decision. Would you pay $5,000 to get a $120,000 tax benefit now, rather than let the IRS give you that $120,000 over 27.5 years or 39 years? That's it. That's the whole story we're talking about here. So that's why I always say I got the easiest job in the world. I'm asking somebody to pay. I'm using an example. $5,000 to offset 200 or even $200,000 of their income. It is really not a hard situation. It's just making sure the client understands that they need to be in the driver's seat, that they're not asking their CPA, does this make sense? All we care about is if you're a real estate professional, if either you or your spouse are a real estate professional, we know that whatever the accelerated amount is going against your total income. We got it. If you're not a real estate professional, let's just make some easy numbers. Easy numbers. Let's just say that you're not a real estate pro. And let's say the cost segregation generates $200,000 of acceleration. So you got this $200,000 deduction out there. But let's say your total passive income is $50,000 a year. Well, 50 times. So it's going to take me about 5 years to use up, no, 5 times 4 is, yeah, take me 4 to 5 years to use up that tax benefit rather than waiting 27.5 or 39 years. So if you're not a real estate pro, all we're saying is you got this $200,000 tax benefit. And if you're making $50,000 of rental income, then it's going to take, it's going to take 4 years. But in reality, wouldn't you rather take the $200,000 over 4 years rather than 27.5 or 39 years? Remember, the higher your passive income over all your rent, remember, it's not just for that property. So if we generate a $200,000 accelerated depreciation and you have $80,000 of total rental income, like we're talking about net, after expenses, it's going to take you about 2.5 years to use it. So even if even if you only had, I'm not making this up, even if you only had $20,000 of passive income and you were paying taxes on $20,000 of passive income, and we could generate $200,000 of tax benefits, accelerated depreciation, all we're saying is for the next 10 years, you're not going to pay taxes. Now, it's not as great if you could take it over 1, 2, or 3, 4 years, but it's also great to not pay taxes for the next 10 years. So every person is different. Please don't throw the baby out with the bathwater. Don't make an assumption that this doesn't make sense for you. So let me kind of give you some of the criteria, just so we can be on the same page. This is for people that are looking to buy rental properties, are people that already have rental properties that at least have spent $200,000 on a property. I would say that's the minimum, because the cost, we have a minimum fee that we can charge. And I would say, and once again, everybody's different. Some people might be in a 30% tax bracket. Some people might be in a 10% tax bracket. And if you're at a 10% tax bracket, I might say it's not even worth it for you. We're going to run the numbers. I'd rather us make the decision collectively rather than making an assumption. So I would say overall, what I would do if I was in your place and you own rental property is you have what's called a depreciation schedule. That's showing your properties, what you bought it for, and how it's being depreciated. What I'd love to be able to do is look at it for you, give you a proposal so you can look at it and go, okay, this is what it'll cost me. Here's what my tax bracket is. Here is how this will benefit me. There's really only 3 variables. It's what's the cost, what's the tax benefit, and what is your tax bracket. So it's not like we're talking about any vague things. We'll be able to ethically and consciously be able to say, does this make sense for you or not? What I've come to the realization is 90% of the time, the numbers do work. But if you only own one property and you're not a real estate professional, then maybe your depreciation expense that you're taking over 27.5 and 39 years, maybe you're not even paying taxes. But that's my job to point that out and say, hey, ethically, this doesn't make sense for you. Hey, you're only paying $10,000 in income, but even your depreciation that you're getting for free is $12,000. You don't need a cost segregation study. You're good. When you start buying multiple properties, or if you're a person that has their property that's paid off, it's a no-brainer because you know that you're making more than what your depreciation expense might be. But that's what I want to go back to the short-term rental person. If you're on this call and you're not a real estate pro and you don't want to wait 3, 4, 5, 6, 7 years to get this tax benefit, the short-term rental, and if you want to take the next step, or the hotel or the motel, but I'd say the short-term rental is the first step. I have really helped so many people come to that realization that if we can dot our I's and cross our T's, and we can make sure that you're materially participating, that this is not being treated as a vacation home, and that we can confirm that no one else is doing more hours than you, then you literally get the same tax benefits as a real estate professional. But it's about walking through the steps. It's ethically making sure that we're not winging it. Like, that's why I don't like this. Don't say a loophole. This isn't a loophole. It's in the law. It's been around for 19 plus years. But you got to know how to do it. And then what my job is to be able to give you the code, give the code to the CPA. Because the CPA is like, what are you saying? You can't do that. Yeah, you can. You just got to look at the code. And that's what happens probably 30 to 40% of the time. That you're not going to have to convince your CPA. I am very OCD and I'm very into paint by numbers. So I definitely want to make sure that everybody's on the same page. It's a walk in the park. We walk through the process and we make sure that you understand what your role is. So when you have that conversation with the CPA, we can do it together. And I can tell you this, to this day, I've probably done several thousand studies. Let's say a little bit over 1,000 studies. And in that reality, if there's ever pushback from a CPA, it's always their lack of understanding or going back to what we said earlier. Hey, John, you don't have to pay for this. Or I even had CPAs say this to me. Now I want you to know this. Tell me if this doesn't make you giggle a little bit, just a little bit. I've had CPAs say, now remember, let's say you're the person that's in a 40% tax bracket. And we have a $300,000 tax benefit. You're 40%. So I've literally saved a person $120,000 they get to keep for themselves. I've had CPAs say, Chris, yeah, it's great. You made a sale. But now, because you took $300,000 of the depreciation, now they only have 70% left. And I'm just shaking my head going, oh my goodness. Thank God your client didn't hear you say that. I mean, it's like give your client the permission to use their tax dollars the way they want to. And that's just what happens. And I'm telling you, it's never that a CPA is saying, don't do it. They just look at it like, hey, Chris, they took that 120,000 and they bought a boat. Now they only have 70% less to depreciate. I'm like, no, hang on. I've coached them. I'm telling them, hey guys, this got you to the dance. This got you 120,000. Let's go buy another rental property. Let's go buy another down payment on another property. You're right. You're right. If you're going to take that 120 grand and you're going to go spend it, dang it. Yes, I made a sale, but now you only got 70% of your depreciation left. Let's make sure we take that 120 and use it as a down payment on another property. And then we can know beyond a shadow of a doubt that it's used properly. So what I'm going to do is I'm going to close with that. And hopefully y'all can see my email address and my phone number up there. And if you have any questions, I'm here to help.
Yeah, Chris, thank you so much. I did put your phone number and your email in the chat. So guys, look at your chat. It's there. It's easy. I think honestly, it's kind of neat. That's why we really like Chris, because clearly you know what you're talking about, and you've done, like you just said, over 1,000 studies. That's incredible. That is someone who's had a lot of experience with real estate investors, which is who you want, not just a CPA who's never heard about it for the first time doing it. They won't understand it. It's a little more technical. And Chris, I love it so much. I mean, the thing is, more money faster as an investor just makes sense. There's opportunity cost. It's just logical as an investor. It may not make sense to all the accountants out there for some reason. I don't know why. I don't understand. But as an investor, which I know most of our students are
Just
on
want
this
the
call,
option. Just give me the option. Just
give me the
give me
option.
yeah. Tell me what something costs. Explain to me how much taxes is going to save me, and then let me determine if I want to write a check or not.
Yeah, I paid 5 to make 150 all day. I mean, faster money. I get it. I get
And
it.
it's like I always feel like I'm asking rhetorical questions. I got to be so careful because I'm like, I know. I always say this. I know this might sound like I'm being sarcastic,
Yeah,
but let's get down to it. Would you spend $5,000 to not pay 100 grand this year?
right. All day long,
And
all
it's like I
day,
know that
every
might
day.
seem like I'm insulting your intelligence, but that's the pitch.
Well,
There it is.
I
That's
don't know
it.
why.
There's
I don't know
nothing
why that's
else
a
to
hard
say.
question.
Does that make
It's
sense or does that make not sense? That's just the way it is.
it makes a lot of sense, and you can see why a lot of real estate investors do it over and over and over and over, offsetting that passive income. And you can see why more millionaires are made in real estate than anything else. Why?
Great.
This is literally, I would say, Chris, in my experience with all of our investors, this is right here why. Primarily because the tax benefits of owning real estate is so extraordinary, you can't afford not to do it, honestly, in real estate. It's just, real estate makes a return, but the
Yeah.
tax makes it
And I want to add one thing what you just said. It's
extraordinary.
funny how I have some clients that literally don't own enough properties and they're very high income earners. And normally, like let's just say if you look at I can show like a rate of return, like an ROI, a rate of investment. And it might be literally 30 to 1, 50 to 1. When you start to get into three, four, $5 million property, 400 to 1. And remember, I'm always doing research because I always want to try to add value to my clients. I haven't found anything after cost seg that's anything more than 15 to 1. And that's awesome. It's
It's
15 to
awesome.
1.
It's awesome.
But in reality, I'm so used to showing people 30 to 1, 40 to 1, 25 to 1, and 400 to 1 that it's kind of like, hey, let's at least max this out. Then we'll go play with the 12 to 1. We'll go play with the 14.
Absolutely.
But in reality, this is where you go first if you own rental properties. And then once you max it out, go fund a IRA, go fund a 401k. But if you, don't get me wrong, but if you have rental property, that's just different. It's just different.
That's where money is made, no doubt. The tax benefits are too extraordinary not to do it. So, Chris, I did put your name, your email, and your phone number in there, guys. I would strongly suggest if you have rental properties, at least reach out to Chris directly. Tell him you're on the call tonight, and he can give you all the details for you personally. He doesn't want to sleep ever again. He'd love your calls. Okay, that's not true. Don't bombard Chris too much, but I know you'd love to take their call and their email and spend time with them. You've been very generous with everyone else we've worked with. So thank you for your generosity. So it's okay for them to reach out to you, Chris, and then you just cut
Absolutely.
back to them shortly when you're available and schedule a call sometime with them.
Sounds wonderful. Absolutely.
Okay. All right. Well, let's do that, guys. So that's in your chat. Do you want to do a few questions? And I know we don't have a ton of time, but if it's okay, we'll do a few questions here and there.
Absolutely. I'm open to that.
Okay, so I'll just try to start at the top here, make our way down. We'll do our best to get through them, and if we can, we'll get through them. Bishma is saying normal depreciation in later years will back as recapture when selling property unless doing 1031 exchange. How does cost seg work in this scenario? Do you still recapture? You kind
Yeah,
of covered some of that.
this is a great question. Okay. So there's a couple ways. Got to remember, recapture is for anybody that owns rental property. Has nothing to do with cost segregation. If you are taking depreciate, remember, when you own a rental property, You have to take depreciation. You don't have an option. So if you're taking depreciation, which is part of owning rental properties, and you sell your property, you are going to have to recapture what you took. So here's the reality. Let's now talk about a 1031 exchange. We know that when you buy rental property and you do a 1031 exchange, as long as it's for light property or larger, you get to kick the can. You get to defer the taxes. Well, in a cost segregation study, as long as as long as even if you did sell a property and you didn't do a 1031, as long as you buy another, remember, it's kind of the same way. I want you to equate cost seg with 1031. As long as you keep doing 1031s, guess what? You don't pay taxes. For a cost seg, I'm giving worst case scenario that you sell the property. Yes, you'll pay recapture. If you don't take the profits and buy another property and do a 1031, excuse me, and do a cost seg. So it's like the cost seg is what's offsetting the recapture as
Yeah.
long as you keep doing cost segs, doing cost segs, doing cost segs. Just like you, if you stop doing 1031s, you'll pay taxes.
Yep.
I'm just saying if you, and we always run the numbers, you know, but you're right. If you sell a property and you take the depreciation and you don't buy another property and do a cost seg, you're right. You'll have recapture. But it's the same thing with a 1031. So you just got to make sure that if you're going to sell a property, are you pocketing it? Then you're going to lose with a 1031 too. We're saying you're right. As long as you are continuing to buy properties and continue doing cost segs, it normally all, because you're buying an equal property, you're literally offsetting it. You're offsetting the recapture. So that's the solution. Then, if you want to get more difficult, as long as you hold a property for 5 years and do a 1031, you don't pay recapture. So those are little things. Got to hold a property for 5 years, do a 1031. But you're right. If you truly are selling a property and you're taking the profits and you're not going to buy another property, everybody, there's
Yep.
no way around you not paying recapture. It's just
Yep.
part of owning rental property. It's no different than the 1031.
Yep.
1031 was great, but don't stop doing them. Once you stop doing them, you got to pay it. And that's what we're talking about here.
Yep. It's playing the game, and
And
you have
also
to have a
everybody's
solution.
specific. So maybe that person has a very different situation, you
Yeah.
know. So it's not everything is a broad brush, but
Yep.
that's a broad answer to
Sure.
most people's concerns.
Makes
Is
sense.
it's contingent upon what your situation is and what are you going to do after?
Yeah.
Because we can have a solution, but you can't just sell the property and expect not to pay taxes and not pay recapture. That's just the way the tax law works.
Okay. A question from Anonymous here.
Uh-oh.
It's a good name.
Uh-oh.
No, it's an interesting question, though. So they've got two rental properties in an uncle's trust that will be distributed this year to me. I am the trustee. Several expensive repairs are being completed now before distribution. Once distributed, would I, as the owner, be able to do a cost seg, or can the trust, which is getting the revenue through rent, uh, do it now until distributed?
I would say that's going to be, I'd say that's a one-on-one call
Yeah,
because because basically it's not an arm's length transaction.
yeah,
Basically, it's not arm's length. So you don't get bonus. You can accelerate, but you can't get bonus. So that's a little bit different. Whenever you exchange properties from people that are within your, it's not arm's length, it's like a family member, the tax law, because you can always do things on the sly. So they're like, hey, you can do a cost seg, but if it's not through death, if it's through death, then it's completely different. If
hmm,
somebody passes away, then it's not it's arm's length. But if it's through like some kind of trust and it's your uncle is literally, gifting you a property, or even if you're buying it, it gets a little bit more complicated. So I would say that's going to be more of an individual consult
Yeah.
rather than that. That's very strategic, and there's multiple different layers of
Yeah.
confusion that I can understand that someone might have.
Okay. So reach out to Chris. Okay. So on flooring, does ceramic or porcelain tile qualify? We don't use carpet in Florida.
I get it, and that's the hard thing about Florida is I love
Yeah.
Florida, but majority is tile, and it's really about us doing research. But normally tile that's like legit tile, that's 39 or 27.5. It just is what it is. Florida, that's what happens with Florida. It's great. You got the awesome beaches and everything else, but in reality, sand would crush wood floors. So it's understandable that tile is going to be 27.5 or 39. I'm assuming you're the regular ceramic tile, that's going to be not 5 years. Normally it's the laminate wood floors, any type of non-nailed down wood. But normally
Fascinating.
in Florida, there's a lot of tile. And so
Yeah.
you're right. That's going to be a 27.5 or 39. But that's just the world y'all live in because of you live in a beautiful place that has beaches.
Just have someone come in and put carpet in and take it off. You'll be fine.
Yeah, there you go. Yeah.
Okay, don't do that. All right, Gene's asking, let's assume I make some renovations to a rental home as opposed to my initial purchase. Can I use the same cost seg or is it only available at the time of the original purchase?
Great question, which I didn't cover. So awesome question. Cost seg applies to purchases, new bills, and renovations, or what's called improvements. So normally for the cost, I would say you normally don't want to spend money on a cost seg unless you have at least 175 to $100,000 of renovations to justify the cost. Because you're not taught, but the good thing about renovations is they're not normally structural. And if it's not normally structural, then you might be saying, well, shoot, if I get a $50,000 deduction, but the cost of the study is 2 grand, that's numbers still work. That's why I always I'll tell people this. I need the breakdown of the renovations. Tell me what it is. Let me do some research because I don't want you to spend 2 grand and realize, oh, wait, it's all structural or it's all things that don't qualify. So those are pre-qualifying questions. Give me the cost detail for what you spent. I'll do the research and I'll know, what tax life does it fall into to see if it makes sense.
Very cool.
I'd say 75 to 100,000 is when you want to start looking at doing a cost seg for the renovations or
Well,
improvements.
Gene, reach out to Chris directly. He can definitely answer some of those questions for you. Got
And
an
we'll know
eight-figure
before.
son.
I'd never bait you. I mean, we know ahead of time. We'd be like, you have the cost detail, give it to me. I'll
Awesome.
I'll take it to my engineers. We'll go, hey man, realistically, they look like about 50 grand. We'll give a range, 35 to 55. Hey, maybe it ends up being 40. Does the numbers make sense if you pay X amount of dollars?
Reach out to Chris, Gene. That's a great one for him. Okay, Tally's asking, is there a difference between mobile homes, manufactured homes, and modular homes, and different time frames, different building codes? Many RV parks are now getting zoning for permanent residents. How's that work?
Yeah, how about this? If you can't move it, it ain't mobile.
There you go. That makes
It's
sense.
got to be able to be moved.
All right.
If it can be moved, it is mobile. If it is attached to a slab, ain't mobile.
Yeah.
Even though you might think it's a manufactured home, if it's to a slab, you can't move that sucker. And listen,
Okay.
don't get me wrong. We can always look into stuff, but the code is saying, hey, if we can't get a trailer and hook that sucker up and move it off, you
It's
know,
permanent.
it's permanent.
Yeah. Very cool. Okay. Beachman is asking again. Great question, though. So you kind of give a range. How much does it cost to do a cost seg, and what type of properties qualify? And most importantly, what's your availability, Chris?
Well, I work from 9 to 5. Monday through Friday from 9 to 5. I'm Central Standard Time, but we're always gonna you're gonna you're gonna know everything up front. You're gonna know the price, you're gonna know the estimation of the tax benefits, and you're gonna know. I'm gonna find out. Hey, listen, we need to find out what's your tax bracket, because those are the three things: cost, tax benefit. Remember, this isn't a credit; it's a deduction. So that's why it's important. Understand what's your tax bracket. Well, let's find out. Let's go find out. Oh, my average tax bracket is 23%. Okay, then we're going to take the cost of the study, the tax benefit, multiply it by your tax bracket, and that's your tax savings. You're going to know that before you do anything. You don't find out after. We can know that before because we have an estimate that'll say it's going to be anywhere between, 75,000 to 100. And we'll say, hey, let's assume that comes back at 85. If it comes back at 85 and you pay X amount of dollars and it's an $85,000 tax benefit and you're in a 24% tax bracket, here's your tax savings. Does that make sense? Does that move the needle enough to make you want to do it? There's the business decision where the
Yep.
tax guy is going, I don't care. Do whatever you want to do. But
Yep.
that's the business decision. It's understanding those three numbers because once again, there might be people that it might be a 5-to-1 ratio. I mean, I'd rather pay taxes at 20 cents on a dollar rather than dollar for dollar. But
Sure.
another guy might say, man, if I can't do this at a 20-to-1 ratio, I'm like, fine, pay it dollar for dollar then. Show the IRS how smart you are. Like pay it dollar for dollar. I mean, 4-to-1's better than 1-to-1. So
You got to play the game.
yeah, it's just the reality is you're going to pay for it dollar for dollar. We're just trying to find a way for you to pay it less than a dollar for dollar. And then you justify that by what your tax bracket is.
Yeah. All right. And this goes along with Tally's question. When you receive accelerated depreciation, however, it's not a cash refund, it's a reduction in taxes paid. Specifically, how does an investor get their hands on the 125 grand for a different investment? That's hard to answer, Tally. It depends on you
Uh,
specifically. Yeah.
but I'll share that real quick. It's pretty
Sure.
simple. And
Yeah.
I'll tell you why it's simple. It's either
Yeah.
two ways. It's either if somebody has been paying, let's say it's end of 2025. We already know 2025 is over. And as of tomorrow, you're filing an extension. If you haven't paid taxes, you're filing an extension. So I would ask that person, hey, you already know what you made in 2025. Let's assume we're going to have a tax benefit of 120 grand. And I'm going to use a simpler number. You have $100,000 tax benefit and you're at a 30% tax bracket. So that's $30,000 of a tax benefit. So it's a $100,000 deduction. I would ask the person, have you already paid your taxes? Yeah, I already paid my taxes. Did you make more? Is your taxable income more than 100? For easy numbers. No, exactly was 100. How much money did you pay? I paid in 15 grand. Well, then you're going to get a refund for $15,000. Or you're somebody that says, Chris, I hadn't paid any of my taxes. And let's say the exact same situation. And that person made 100,000, taxable income's 100 grand, but our deduction is 100 grand. And I'll say, hey, buddy, remember the 15 grand that you didn't pay? You don't have to pay it now. So it's either going to come in, if you didn't pay, you don't have to write a check. There's the planning. It's saying, why wait on a refund? If you know you're going to do a cost seg, why are you paying all your quarterly estimates? If you know you're doing a cost seg, don't pay them. You don't
Yeah.
have to.
Yeah.
But most people wait until the very end and then they have to wait. And listen, God bless, 4 or 5 months to get your refund. I don't know. I don't know how this IRS works. Sometimes they're open, sometimes they're not. I'd rather not write them the check
Yeah.
than write a check and get a refund. So that's the difference. is if you've paid it all, that tax benefit's coming in a refund. If you haven't paid, you get to keep the money that you would have paid.
I love it. Great answer. A great answer. Honestly, Chris, I appreciate that very much. Your time tonight. You're super generous with your time. And again, guys, Chris has been very generous with his time with all of our students, and you're getting a lot of thank yous here. Everyone's very happy with your webinar tonight and your information shared. It is kind of a thing that I think a lot of people don't know about, and once you know, and once you do your first cost seg, it opens up your mind and your brain. As an investor, me personally, same thing. And just, wow, I can do a lot more. And so
Yeah.
it's cool to have
It's
someone like
also
Chris.
giving you the confidence
Yeah.
and to kind of
Oh,
tell
yeah.
you stories of like, hey, listen, let me tell you about this person that makes $120,000 a year, and let me tell you how they didn't pay taxes this year. Well, they bought a short-term rental. Well, what do you
Yep.
mean? Let's walk you through
Yep.
the steps. Let's. We don't have to go buy a $4 million building. We don't have to buy a mobile home park. We can take small steps. We can go buy a $250,000 short-term rental. That's what I call training wheels.
It's getting in the game,
Getting
and
in the game and then not writing a check for 30 grand and
it is
go,
so
whoa,
cool,
whoa,
Chris.
I don't write a check for 30 grand. Wait, how is that possible? Well, it's part
Yeah.
of being in the real estate game.
It's getting in the game and being in the real estate game. Again, I really do go back to that. More millionaires created through real estate than anything else. And this is a big piece of the equation right here. Everyone thinks it's just buying rental properties. It's part of it, but it's
It's
doing the
keeping.
strategies.
Think about this. What you just said. It's can you imagine the amount of taxes you paid every year for 30 years?
Yeah.
How about you keeping that?
Yeah.
How would
Imagine.
that change your retirement? That's
How
just
would
all
that
it
change
is.
your life right in a couple years, even? I mean,
Yeah, it's
really.
saying, hey, if you're paying $30,000 a year in taxes and you don't do that for 10 years, that's $300,000 you just saved. And
It
you
is
didn't
a
invest any
game
money.
changer.
That's just tax savings. That's
It's
just
a
tax.
game changer. Guys, it's a
It's
game
pretty
changer.
awesome.
You don't have to be filthy rich. You don't have to have
Yeah.
hundreds of properties. It just get in the game and you have a great connection here with Chris. Again, that's in the chat, guys. I would strongly suggest if you have rental properties, you have questions on this, even if you're not on the edge if it makes sense or not,
Yeah.
contact Chris. He can tell you pretty quickly. Obviously, he's a good guy. He knows what he's doing with a great company that's been in the business a long time. They're the best at what they do. So, Chris, thank you again so much for time tonight.
Thanks, guys. You have a wonderful evening, and thanks again, Kendall.
Everybody, yeah, thanks so much, Chris. Thanks for being on, everybody, tonight. We really appreciate it. We look forward to seeing you guys hopefully next week at the summit as well. And please reach out to Chris and his team. Thanks, everybody, for being on tonight.
Good night, guys. Good night,
Thanks,
guys.
guys. Have a great night.